some marginal additional costs, it's completely irrelevant. It's at the point where the asset is sort of ready to be able to be used rather than actually being brought into use. Okay? So how do we measure cost? Well, you measure cost at fair value. Again, the usual cash cost of actually sort of bringing the asset up to the stage where it is ready to use. Subsequent expenditure, well, subsequent expenditure is one of those areas, again, that sometimes causes a little bit of confusion. You are allowed to include subsequent expenditure subject to certain criteria. So, what kind of costs can we include in this? Well, the first thing that you can include is anything that enhances the economic benefit. Okay? So anything that enhances economic benefit can be capitalised. Now this would be, let's say I have a machine, and that machine has a motor that can produce 5,000 items a day. And I decide to replace the motor, and it now can produce twice that amount. Well, because I have enhanced the economic benefit of the machine, then I would be allowed to include the additional expenditure on the new motor. Okay? The second sort of area that I can include would be if there was a sort of the cost of an overhaul. Now, I'm going to use a very simplified example. Let's take an aircraft. And again, this isn't what actually happens, I assure you, so don't worry next time you're on a flight. But let's say, for example, every 10 landings that an aircraft does, they have to wipe the windshield, pump a bit of air in the tyres, and basically just check the oil and water. Okay? Let's say that every 100 landings that an aircraft does, they kind of check the hydraulics and they just give it a service. But every 1,000 landings, let's say they strip out every hydraulic and electrical component within that aircraft and refit it. Well, because it is a refit, and effectively what you're getting at the end of it is pretty much a new aircraft, then you would be allowed to include the costs of that complete overhaul. You would not be allowed to include things like scheduled servicing and general maintenance. But if it's a cost of a complete overhaul, then you would be allowed to. Okay? The other thing to consider here is the idea of component parts. Now, you can take this to extreme a level as you actually want to. But the idea here is that if when I capitalise my asset, I break it down into its component parts. So for example, I purchase an aircraft, I decide that the engines are going to be separable from the aircraft, so I'm going to have to replace the engines in, say, 5 years. I also think that the wings are probably going to need to be replaced every 10 years, and the rest of the aircraft is going to last 20 years. Well, what I can do is I can separately capitalise the engines, the wings and the fuselage as 3 separate assets. That way I depreciate the engines over 5 years, and at the end of 5 years when I have to replace them, I can recapitalise the cost of the replacement parts. If I don't separate it out and I just capitalise the aircraft as a whole asset, when I have to replace the engines, that would then be seen as maintenance, in which case I would not be allowed to capitalise the addition. What we have so far then is this idea of kind of like subsequent expenditure and the initial sort of recognition of cost. What we now need to talk about is depreciation. Okay, now depreciation is, as we know, nothing to do with valuation. I lose count of the number of conversations I have, quite often with very senior people, where they're sort of saying, oh yeah, no, we depreciate that asset so that we've got enough funds set aside for replacement. That's not what happens at all with depreciation. As we all know, depreciation is merely an allocation of cost. Now, in your pre-course test, there was one of the questions there which talked about the application of the accruals concept. And I now had an email from somebody about this. So just to clarify, depreciation is the purely sort of the application of the accruals process. What we're doing is we are matching the cost of an asset to the periods over which it's going to bring in revenue. So if it brings in revenue over 5 years. We're taking the cost of that asset, we're taking a little piece of it and putting it in every single year. Okay? So that's the process of depreciation. Now we have two different ways of looking at assets subsequent to their initial recognition. We can carry them either under the cost model or the revaluation model. Okay? So we can either carry them under cost or revaluation. And don't worry, I'll show you what I'm writing on the computer in a moment. If we carry them under either model, we would still be required to depreciate that asset over its remaining useful life. From a terminology point of view, you may have heard people talking about remaining useful economic life. The word economic doesn't actually exist under IFRS as part of this, so it's actually just useful life. So if ever you see useful life, it means the same thing that you may have heard of referred to before as useful economic life. Okay, so the idea being is you would depreciate it over its useful life down to a residual value. We'll talk more about residual values and useful lives sort of a little bit later on, but these would normally be assessed at the date of acquisition of the asset. And the idea would be is that you use a systematic approach for how to deal with depreciation. Now, in terms of depreciation, there are any number of different methods. The most common ones are straight line and reducing balance. But bear in mind, the standard itself does not require you to use straight line or reducing balance. The standard itself says that you must account for depreciation on a systematic basis. Now, we use straight line and reducing balance as two examples of systematic basis, but you could use a sort of a usage basis. So you could use a units of production basis. Now, as I'm sure that you're aware, we would normally go for one of the main two, which is straight line and sort of or reducing balance. But the idea of this unit of production method is certainly for things like plant and machinery quite a sort of an interesting approach. Sometimes it's a bit mathematical and you start saying, is it really necessary to do it? Well, like I say, it's just another example of a systematic basis. Okay? So all we do with the units of production method is you'd look at how many units that machine is expected to produce over its useful life, and then every year you would look at what proportion of units have been produced and take the sort of the units produced divided by total units to be produced over the life of the asset. That gives you the proportion that you multiply by the actual cost of the asset, and that's cost minus residual value. Okay, so it's very similar in a way to the straight line method and the the reducing balance method kind of combined. So you're recognising it based on the actual cost price of the asset, but you're spreading it over the life, and you're relating it to actual direct levels of production. So a lot of manufacturing companies prefer to use this method just because it actually gives them a more accurate sort of accruals based approach to sort of depreciation. Okay, now if you care to have a look in your notes on the illustration 2, please, on page 91. Okay. Oops. What's gone there? Oops, my apologies, not quite sure what's happened there, we just lost picture for a second. There we go. Okay, so if you just have a quick look at illustration 2, please, on page 91. Okay, what you'll see there is we've actually used the so that straight line method and the units of production method and the diminishing balance or reducing balance method. Okay, so you can see that in each of those three different cases, in the straight line method, we get a depreciation of 1,000 currency units per annum. Okay, if we use the units of production method, we get 500 in year 1, 800 in year 2, 1,000 in year 3. So it's only actually year 3 where we get the same amount of depreciation being charged. If we use the reducing balance method, we're going to be using 2,500 in the first period, 1,875 in the second one, etc., etc. So as you can see, straight line method is, as you all know, I'm sure, by far and away the simplest method. Okay. However, there are a couple of very easy mistakes that people have a tendency to make when dealing with sort of straight line depreciation. The thing to remember is that you are depreciating the depreciable amount. You're not actually depreciating sort of the whole cost of the asset. And the depreciable amount is given to us as cost minus residual value okay, so cost minus residual value. You would then spread that over the useful life, or you would multiply that by a percentage. So if I said we're going to give this asset a life of 10 years, I could either work out that and then divide it by 10, and that would give me my annual charge, or alternatively I could just multiply it by 10%. Okay? So the depreciable amount is cost minus residual value. Now, you may wonder why I'm making a big issue out of this. The reason I'm making a big issue out of it is because in the certificate in IFRS that many of you will be going on to do, this is quite often one of the most common mistakes that people make. When they're dealing with assets and depreciation, they tend to simplify it and just take it as cost times 10%. Just remember that you have to take into account any residual values in that. Like I say, you can almost get that'll be there for A, B, C or D will actually sort of offer you the answer of cost times 10%. So like I said, it's a very common mistake, so please don't fall for that when you're doing your multiple choice tests. Okay. So we don't use cost times 10%, use depreciable amount times by 10%. Okay. In reducing balance, you would just use the net book value multiplied by the percentage. The actual residual value is reflected in the percentage that you use. So the residual value is already taken into account in arriving at that percentage. So if I gave you a question that said the asset has a cost of 1,000, a residual value of 100, okay. If I was using straight line depreciation, I would take 1,000 divided by 100, minus 100 divided by the useful life to give me my charge per annum. If I was using reducing balance, I would just take 1,000 times by a percentage. I wouldn't need to factor in the residual value in that case. Okay, the residual value is already reflected in this actual percentage. Okay. Like I say, very, very common mistakes to make when dealing with questions. In the real world, it's slightly sort of less of a problem. Now, this brings me on to this whole idea of residual values and useful lives. Okay. The reason why I want to draw attention to this is because I mentioned earlier that the details within IAS 16 is what causes, or what often causes the problems. So we're going to look at residual values. Now, the residual value of an asset has to be assessed at each year end. Okay, so what is the actual consequences of this? Well, what it means is if I was to buy an asset, okay, for 1,000 say, and at that point give it a residual value of 100, and this would be what I expect to be able to sell this asset for at the end of its useful life. Okay, so on the day I buy the asset, my cost is 1,000, my residual value is 100, and let's give this asset a 5-year useful life. Okay, so we've got cost of 1,000, residual value of 100, or RV of 100, and we've given it a 5-year useful life. So in year 1, my depreciation charge is going to be 1,000 minus the 100 residual value divided by 5. Okay, so 900 divided by 5, which gives me 180. Okay, so my depreciation charge in year 1 is 180. Okay, nice and simple so far. For year 2, however, I need to now reassess the residual value. Now, this particular asset has suddenly become quite popular. Okay, it's a bit retro, it's a little bit of what people are looking for, so therefore all of a sudden the residual value of this asset is now 150. So it was 100, it's now gone up to 150. Therefore, in year 2, my net book value at the start of year, okay, well, if it was 1,000 to start off with and I've charged 180, my residual value is 820. Therefore, my depreciation charge is going to be 820 minus 150 divided by the 4 remaining years. So it's still straight line depreciation, but by having to reassess the residual value again, it actually makes the depreciation different. So I've got 820 minus 150 divided by 4. So in year 2, my charge is now 168. Okay, so let's go through it again, make sure that you are all comfortable. So on the date we bought the asset, it cost us 1,000 and we gave it a residual value of 100. And it stayed that way for the rest of that year, and we gave the asset a 5-year life. So in year 1, we got cost minus residual value, giving us 900, divided by 5, means that at this point we anticipate that the charge for depreciation each year is going to be 180. Okay? However, having charged 180 in the first year, we then get to year 2, where we then say, what is the residual value at the end of year 2? So at the end of year 2, we say, in 4 years' time we'll sell this asset. How much will we sell the asset for? And the residual value is assessed at 150. Therefore, we need to depreciate this asset from whatever its value is now down to its new residual value of 150 over the remaining life. So its current carrying value is 820, which was the 1,000 minus the 180 that we'd already charged. So you get 820 minus the 150 residual value over the remaining 4 years, which gives us a depreciation charge in year 2 of 168. Okay? Right, let's just do one more year just to make sure that you are happy. So in year 3, my residual value has fallen. And my residual value has actually now gone down to 50. The bottom has dropped out of the market on this particular asset. We're having a global credit crunch, and therefore no one's buying these assets anymore. So the residual value is now 50. The net book value at the start of the year would be 820 minus the 168, so it's 652. So it's the original 1,000 minus the 180 depreciation in the first year minus the 168 depreciation in the second year. So the charge for year 3 is going to be 652 minus 50 divided by the remaining life, which is 3. So 652 minus 50 divided by 3 actually takes us now a charge of 201. So in year 1 we had a depreciation charge of 180, in year 2 we had a depreciation charge of 168, and in year 3 we have a depreciation charge of 201. Now all of this is all very well and good, but what does it actually mean? Okay, now I'll leave that up for a second while I carry on talking, because I can see some of you are still writing it down. Okay, but what it actually means to us is that when we get to the end of the asset's useful life, in theory there should never be a profit or loss on disposal, because we've already reflected a change in value of the residual value over the life of the asset. Well, that makes sense, doesn't it? Because at the end of the day, at the end of an asset's useful life, we shouldn't really be making profits and losses, because that's not what we're in business to do. We're not in business to buy and sell assets. We're in business to use those assets to make products to sell to the market. So the fundamental principle is that we're trying to do this to remove profits and losses on disposal of assets at the point of the end of their useful life. If we dispose of them earlier, well, we'll deal with that in the next session when we deal with assets held for sale. But the principle is that they're trying to get into the situation where we are removing profits and losses on disposal of property, plant and equipment from our accounts. And this is one way that we will do that. Okay, so the idea being is that we are reflecting a change in the residual value over the life of the asset and therefore through depreciation, rather than waiting until we get to the disposal of the asset at the end of its useful life and having a sizable profit or loss on that disposal. Okay. So, we have to reassess the residual value at the end of every year. The other thing we have to do is we also have to reassess the useful life of the asset. So at the end of each year, not only are you looking at residual values, but you also have to consider whether the useful life of the asset sort of has changed. Okay. Now, if the useful life of the asset does change, or the residual value changes, one of the things that we have to do is we have to reflect that through depreciation, as we've already said. And there is a very quick approach that you can adopt here that will really help you understand both this and the next thing that we're going to be covering, which is the principles of revaluation. Okay? And what I'm going to do is I'm just going to draw kind of like a couple of little graphs and speak while I do so. So, let's say then, for the sake of argument, that I buy an asset, okay, and it cost is recognised at there. So just drawing a little graph, very simple. And like I say, this isn't necessarily something that you're going to want to spend a lot of time writing down, because once you've seen it, you'll go, ah, I understand. So that's my cost of this asset, and I have given it a residual value at that level. Okay? So I'm establishing a residual value at that point, and I'm establishing a useful life of that long. Okay, so I'm estimating the cost, or the cost is the real number, I'm estimating the residual value, and I'm establishing the useful life of the asset. Okay? Now, under normal circumstances then, you would expect this asset to be depreciated over its useful life down to a residual value. Okay, so this is going to be the net book value of the asset. Okay, so that line would be the net book value of the asset from cost down to residual value over the useful life. Okay. Now what we're saying is that at each year end we have to reassess the residual value and also the useful life of the asset. Okay, so let's say, for example, we get to the end of year one. Okay, so filling in these dots, we get to the end of year one. Okay, so year one, we look at that useful life, and we think that the useful life is actually going to be longer than we initially assessed. Okay. Okay, so that's new useful life at the end. So we're moving the useful life from there to there. Okay? So the first useful life was at point number 1, the second useful life is at point number 2. So at the end of year 1 we've established that the asset is actually going to last for considerably longer. All we would do at the point where we've changed, so at this point here, year 1, all we would basically do is we would now continue to depreciate the asset over its new useful life down to its residual value. And assuming that the residual value hasn't changed, all we would do now is we would continue to depreciate that asset, slightly wobbly line, down to its residual value at the end of its useful life. If the residual value changes, then we would do exactly the same thing. We would move up the residual value, and then we would depreciate the asset from there down to its new residual value, kind of at the end of its useful life. So at the date of change, you just take the net book value and you continue to depreciate it over its useful life. Now you might say, why did I draw a graph? Well, we're going to move on now to the principles behind revaluations. Okay, now with revaluations, this graphical approach is going to suddenly make a lot more sense and be very useful for you to be able to understand exactly what the procedures are with dealing with revaluations. So, circumstances that we have then. Once you've recognised your asset and you've established a useful life, you've established a residual value, what we then do is we then decide how we're going to continue to treat this asset. And we have a choice of two models. Over this side, we have the idea of carrying it at historical cost, and over this side, we have the idea of carrying it at revalued amount. Okay? So we have historical cost and revalued amount. If we carry it at historical cost, then all we're doing is we're depreciating it over its remaining life down to its residual value, and that's all we need to do, apart from, of course, reassessing the residual value and the useful life of that asset on an ongoing basis. If, however, we're over this side and we carry it at the revalued amount, then we have to adopt several sort of additional requirements. So there's considerable sort of other rules. First of all, we have to revalue all assets within that class. Okay? So we must revalue all assets within that class. However, we don't have to revalue all of the assets simultaneously. Okay? So you have to carry each asset in its class at revalued amount, but you don't have to revalue every single asset sort of at the same time. So let's say, for example, I own two properties. One of them is in a very rural area, and one of them is in the middle of a major city. It could be that I have a policy of revaluation, so I'll actually revalue both of these assets to fair value. However, I might revalue the one that's in the rural area every 10 years because its value doesn't change very much, and I might revalue the asset that's in the city every 2 years because its value changes frequently. And IAS 16 requires that we revalue all assets within the class periodically. Okay? Now, we would often take that to mean at least every 5 years, but the standard doesn't say it. The standard just says periodically. Okay? So, the question remains then as to why an asset, or why you might want to carry an asset under the revaluation model. The simple reason being is it strengthens your balance sheet. It improves your gearing, okay, or your relationship between debt and equity. Okay? And that's really the fundamental reason for adopting a policy of revaluation, is it's literally just to be able to recognise the value of those assets in your balance sheet. It actually does a lot of damage to a lot of the key ratios. So usually when you see a business starting to revalue its assets, it usually means because it's struggling a little bit, so it's under financial difficulty. If it has started revaluing, it obviously has to continue to do so, so that no longer applies. But in the first instance of them revaluing their assets, it's usually because of the fact that the assets themselves sort of are more important than the profits of the business. Okay, so in other words, gearing difficulties. So we have a policy of revaluation. We have to revalue these things then. We have to revalue all assets within the class. Oops. And obviously, this is to sort of like land and buildings. Okay. So we must revalue all assets within their class. You would revalue to fair value. Now I'm sure you're all thinking, I know what he's going to say now. He's going to start talking about his DVD collection again. Well, I'm not, because I think we're comfortable with what a fair value is. Again, arm's length transaction between a knowledgeable buyer and a willing seller. So what we're looking for there is some measure of kind of open market value. Okay? So what I would get if I sold it at open market value, that's what I mean by OMV. So revalue all assets within the class to open market value. Bearing in mind, if that asset is specialised, you would value it at depreciated replacement cost. Okay. Now, a specialised asset could be something like a football stadium. Okay. If you have a football stadium, then clearly it's going to be very difficult to convert that into shops or offices or houses. If you were to sell it on the open market value and the developers came along and just bulldozed it and turned it into shops and offices and houses, it might have a very different value from sort of the actual value that it has as a football stadium. You know, for example, sort of if you were looking at Manchester United Football Club in the UK, okay, and you looked at Old Trafford, the location of Old Trafford is right in the middle of a really highly valued residential and industrial area. If they flattened that stadium and as I'm not a Manchester United fan myself, I don't have a problem with that. But if they were to bulldoze that stadium and build flats and offices, they'd probably be able to sell it for an awful lot more than its value just as a football stadium. Okay? So if it's specialised property, you carry it at depreciated replacement cost. The easiest way to think of that is to work backwards. Okay? First of all, what is replacement cost? Well, replacement cost is the cost of rebuilding it brick by brick, stone by stone, to exactly the same specification that it already stands. The problem with that, of course, is that gives you a brand new asset, and the one that you're trying to value may already be 10 years old. So that's why you bring in depreciation. So you'd say that asset would normally have a useful life of, say, 20 years. We are 10 years of the 20 through the life of that asset, so we take the replacement cost and we would deduct 10/20ths to give us a depreciated replacement cost. So we would use depreciated replacement cost for any specialised assets, so any specialised properties, sometimes for highly specialised equipment that's used in sort of production processes, okay, should you be revaluing it. So, normal rule is to take it to fair value, okay. However, if it is a specialised asset, then you use depreciated replacement cost. As I said, you must revalue every asset within that same class. You must revalue them periodically, and it must be done by somebody who is suitably qualified. So someone who is a member of a recognised body of valuation experts. Okay? Once you've revalued this property or this asset, you would continue to depreciate it over its remaining useful life down to its residual value in exactly the same way. Okay? So how do we deal with revaluations? It's very simple. I'm going to simplify this for you again by using my graphs. So again, let's say that we have an asset, okay, and it cost that amount. I'm going to assume it has a nil residual value, and I'm going to just use its useful life as kind of like where I've put a little star on the bottom there. Okay? So the useful life is that. So therefore we anticipate that this asset, if it's depreciated at straight line, will effectively follow this line here. So I apologise if it's a bit bumpy, but I'm doing this freehand. Okay, so that's where it ends up. So that's my residual value. I expect the net book value of this asset to follow that. As we depreciate the asset over its sort of useful life, that is kind of how we expect this asset to be carried. Okay? Now, let's just say I carry this asset down to this point here, okay, and I undertake a revaluation. Okay? So at that point there, I do a revaluation. Okay? And this revaluation increases the carrying value of that asset. And let's say it increases it to that point there. Okay? So that is now the revalued amount. I would now continue to depreciate this asset from its new revalued amount down to the same residual value, which is nil over the same useful life. I could change it, but for the purposes of this example we won't, because we'll keep it simple. So I would now expect to continue to depreciate this asset down to the same residual value. We now go a little bit further.